Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in 45 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going, bro?
I'm very good, Bryce. How are you?
I'm very well. We continue on our shallow dive of Australian companies on the ASX, publicly listed, that have been recommended by our community to have a bit of a look at. And we have had a great spread of companies, and I'm really excited to be talking about this one today, Ren, because it certainly feels like it's going to fit within our circle of competence because it's all about beer.
Jeez. Just really... Fair enough. No, I think this is a good one. This is an interesting one.
So this one has actually been recommended a few times, suggested a few times by our Equity Mates community. So
I think it was the most suggested when we put the call out for what stocks we should do for this segment.
Nice.
Yes. So we better do a good job of it.
Uh-oh. So we are talking about Gage Road Brewing Company. The ASX ticker is
GRB.
GRB. And it's currently trading at 8.5 cents.
Yes.
And market cap of 94 million.
Yeah.
So it falls within that small cap range.
Yep.
And yeah, some exciting times ahead. So Gage Brewery started back in Fremantle, Western Australia over 14 years ago and have been crafting beer for quite a while now. They've got ales and lagers and all things in between. My favourite beer is an ale, Ren. What about yours? Actually, lager. I don't know.
What's the difference?
Spelling.
Yeah.
Ale has 4 letters. Lager has 6.
Ale's got 3 letters.
Ales.
So let's actually break this company down and start explaining who it is. So it's been around for 15 years, based in WA.
Yep.
It's one of the largest independent brewers in Australia, because the dirty little secret of the beer industry is, whilst it looks like there's a lot of choice when you look on those shelves,
it's all the same.
You're all giving it to Carlton and United, Asahi. There's not a lot of independent brewers.
How have these survived so long without being snapped up, I wonder? Just keep saying no? Or have they not even been offered an acquisition?
You'd have to ask them. They don't make that public, I don't think.
Surprising.
So they're worth about $100 million, which is pretty impressive in 15 years for a small brewer. Very heavily WA based. The name relates to an actual road in WA, but they sell throughout Australia. Now, their business is segmented in 3 main parts. So they've got their own brands, their Gage Road brands. They've got volume that they contract brew. So essentially they brew for other companies. You know, if Liquorland wants to make a beer, they'll go to the market and say, we want to do a Liquorland branded beer. Who can make it for us the cheapest? And so they do some contract brewing there. And then the third segment is a brand that a lot of people probably are familiar with, which is Matso's, the ginger beer. You familiar with it?
I'm not, Ren. I'm actually just looking at all their brands now, and I've never had one of their beers.
Yeah, right. Okay.
Yeah.
I've definitely
Have you?
had. Yeah, I've had this ginger beer before. Their big brand in their Gage Road own brand portfolio is called Atomic Beer. I've never had that. I hadn't even heard about it, but maybe we're missing out. Maybe we should move away from the...
This is making me so thirsty. I just want to quickly double back on something you said, Ren, before we get slammed by our Western Australia listeners. Gage Roads is actually a strip of ocean. Between Rottness Island and Fremantle in Western Australia.
There you go.
Not a hard surface road. So
why is it called a road?
I don't know. I haven't named the maps over in Western Australia. It's confusing.
It is.
Yeah, but anyway, it's a strip of ocean.
There you go.
Yeah, out in the harbour somewhere. But anyway, back to the brands.
So for people who are not familiar with Matso's, it's a relatively big brand that Gage Road purchased last year. So obviously they see growth in that sort of ginger beer, alternative beer space. But that's really the business in a nutshell. They are in the midst of a strategy they're calling Return to Craft. I think 2019 was year 3 of that. And I think that is because they recognize that that's where the value is. Compared to doing that contract brewing that I was explaining earlier, which they do for Endeavour, which is
it's Woolies. Yeah.
Soon to be divested or sold, but
Yes.
amongst others, Pinnacle Liquor Group, I'm not sure who they are.
Woolies.
Are they Woolies as well?
Yeah.
Okay, so it looks like they do a bunch of contract brewing for Woolies, but the margins are squeezed there.
Right, yeah.
And it's not your own brand, so you're not building any brand equity by brewing those beers.
Yeah.
So they've got this strategy that they started in F17 called Returning to Craft. So they're 3 years into that at the moment, and if you have a look at how the growth of their own brands have fared, they grew 23% between F18 and F19. So you can see that real focus on pushing their own brands, those brands that you looked up and you'd never heard of. At the same time, their contract brewing volume dropped. Part of that was because of the acquisition of this Matso's brand. So that's the business in a nutshell. Anything to add at that point?
I'm just so surprised that they've managed to remain independent.
Why?
I guess I'm just looking at the strategy, and their number one is to become the number one independent supplier to the national beer market. So they obviously...
But I reckon every big independent would say that.
Yeah, but do they... I think surely...
No one's saying our strategy is to be number two.
No, I'm saying their strategy would be to just be bought out, exit, cash out.
Mate, you're just such a capitalist. They do this for the love of the beer.
No, they don't.
Mate, you're unbelievable. Also, do you put it as your strategy? Like, our strategy is to get bought out within the next 3 years?
Yeah.
Surely
Investors want to know what your
Surely you're like, our strategy is to be number one, wink, wink, nudge, nudge, then we'll get bought out. Like, that's subtext.
Make it transparent. Make it transparent.
Mate, I'm saying these guys aren't going to sell out. They love that strip of ocean.
Western Australia. They've got a Redfern microbrewery. Interesting.
Yeah,
we'll have to go check it out.
Let's get to that in a second. To your point around if they were looking to sell out, you would much rather sell a business which had some really strong craft brands that then had brand equity that you could then get a higher value, rather than just being a big contract brewer where, Endeavour Drinks might say, why would we buy them? Let's just build our own factory. So I think, to your cynical way of looking at the world, if every small company just wants to be bought out by a larger company, then this is the right strategy to do that. It's also the right strategy to grow their margins and grow their business and continue to be an independent brewer. So I think either way, it's probably a smart strategy. You mentioned the micro pub.
Yes, microbrewery in Redfern. So good to know they're actually coming across this side. I just really want to try these beers.
I'm pretty sure they're distributed on the East Coast.
I just haven't seen. I think
we'll go to the bottle afterwards.
Yeah, I think the only one I've seen is that number one beer, Single Fin, the bottle. Anyway,
okay. I haven't heard of that one.
We digress.
Yeah, so it looks like what they're doing with the brewery is focusing on this atomic beer label.
Yeah.
It seems like a smart decision in terms of like a marketing and engagement and brand awareness thing. I can't imagine that microbreweries are, highly profitable. But yeah, I think it'll be cool. We should do some research and go check it out.
Okay, Ren, so we need to go and drink some beers to do some testing.
We do.
But from a financial standpoint, let's move into that. So market cap of 100 million, so certainly on the rise.
Yes. Well, not quite on the rise. I think its share price has been relatively flat this year.
Yeah, topped out, I think, in February this year at 12 cents and is now back down to 8.5 cents.
8.5.
Yeah, so a bit of downward movement there. But from a revenue point of view, Ren, we've seen that revenue from activities last financial year ending June 30 is up 20% to 39 million, which, pretty impressive for a brewery firm. Profit from that, net profit, is up 28% to 2.6 million.
Yes. Now, this is probably a good point to talk about the impact of acquisitions, because this is the first year that this Matso's acquisition was factored in.
Yeah.
Now, it doesn't actually look like the numbers were affected too much. They made 33 million last year and they made 39 million this year, but it would be interesting to know what the split of that is, that the difference is between organic growth and acquisition growth.
Yeah, right. So Gage Brands has grown, their main one's grown 23%.
In terms of the volume of...
Yeah.
Yeah.
Litres. So they've sold more beer. In a declining market, I understand, Ren, beer is actually on the decline, generally speaking. So they've done well to grow volume. In terms of course, Matso's not going to appear there because they've only just acquired it.
Yeah. So it's gone from 0 to 1.6 million litres.
5.2 million litres of beer sold for Gage Road's brands
in
2019. Wow, it's a lot of beer.
Yes, yeah. So you can see there that the total number of beer that it sold went from 11.9 million litres to 12 million litres, so barely moved, but its profitability jumped 28%. And the reason that the litres barely moved but its profitability jumped so much is because when you're selling your own brand rather than doing contracted volumes, because contracted volumes fell and their own brand increased, the margin is just better on that.
Yeah, absolutely.
Yeah. So I think that that's the big thing to take away. If you're looking at this company and you're valuing its metrics, a big thing to think about is its sales mix, because, I mean, this is the same with any supplier in terms of that supply supermarkets or liquor stores these days, is that all sales are not created equal, and some are a lot more profitable than others.
Surprisingly as well, where they're selling has had a bit of a change on FY18. So national chains, I'm assuming that's your
Liquorland, Dan's,
still remains as their number one channel for distribution. 3 million litres go through there. But then your independent retailers, 2.4 million litres have been sold through those guys. I'm assuming that's Joe Blogg's bottle shop on the corner. And then Tap Beer Draft, 1.3 million litres have gone through there, an increase on last year as well. So getting that sales channel is pretty important for them by the looks of things.
Yeah, 100%. They've also got the exclusive contract to Optus Stadium, the new stadium in Perth.
Not bad.
Yeah. I think they did 1 million litres through that stadium last year. So any West Coast Eagles or Freo supporters or Australian cricket fans or whatever else they do at that stadium, if you want to invest in Gage Roads, go support your investment and have a few beers at the footy.
You probably don't get a choice if that's the beer on tap.
True. You don't have to drink when you watch the footy, Bryce. I know you think we do.
It falls within the consumer staples sector in the market. Its price to earnings, if we start looking at valuation, is coming in at 28.3, so reasonably high. However, the sector is 24.1, so a little overpriced relative to some of its competitors in the industry, but obviously all of its competitors within the consumer staples industry are not going to be microbrewers and of the like, so there's going to be a whole mix of companies in there. So comparing it that way might not be the best way to compare its valuation. Yeah. You want to move to DCF, Ren?
Yeah, so if we have a look at trying to do a discount cash flow, and we start with its earnings per share, which is fractions of a cent, so 0.26 cents per share, and we say, look, even though it grew at 28% this year, I think that's ambitious. So if we say over the next 10 years, it'll grow at an average of 10% a year. After that, it'll just grow at inflation, although Bryce is hoping it gets acquired. And then we always use the same discount rate for this, the rate that Warren Buffett and Roger Montgomery both recommend. So we just use a 10% discount rate. So if we plug those numbers in, what we get is a price of 4 cents per share, which is below the 8.5 cents that it's currently trading at. If you were to reverse it and say, let's use those numbers, let's use the 10% discount rate, its current earnings per share, and we say, what is the stock telling us that it needs to achieve in terms of a growth rate over the next 2 years to justify that share price? What we see is that the number is about 21% a year. So, that's sort of in line with what they did this year, but sustaining that growth rate for 10 years is probably unrealistic.
Yeah, I think the tough thing is the market at the moment. We know that alcohol consumption's going down.
But still, like even if beer consumption was flat, it's such a competitive market because they compete with all these big brands, and like shelf space is so difficult to get, and tap space at pubs is so difficult to get. 20% a year, I mean, it's a relatively small base compared to some of the bigger brewers, but...
Let's say 5% growth year on year. Yeah, it's still interesting. Well, as I said, I'd be going for the exit. Go for the sell.
So if we do the other valuation method that we've been talking about, this one that Roger Montgomery wrote about in his book, which really looks at the company's book value per share, and it looks at how it's growing through its return on equity number. What we see is that its current book value per share is 5 cents, and its return on equity, if we average out the last 5 years, it's pretty low. It's 4.06%. So that's not really great at all. If you plug those numbers into the table that Montgomery includes in his book, you get a suggested share price of 1.09 cents, which is well below what it's trading at.
Significantly below.
Yeah, and the reason for that is because the return on equity is so low. It's just not really good enough. Yeah. But, if it starts crushing it with its own brand and improves its margins and it improves its return on equity, then there's no reason to say that can't change. But just based on historical performance, it's probably not there. There's one last thing that I want to call out in terms of a red flag. It currently has no debt, which is great. It cleared all its debt, I think, 2 years ago. F17, it had some debt, no longer. Stoked. That's great. There is a red flag buried in that, though. It's done acquisitions over the last couple of years. It's built a new canning facility for, I think, like $7.8 million or something.
Redfern Brewery.
Yeah, there's money being spent. And so you have to ask, well, if it's got no debt,
where's it coming
did
from?
it just have heaps of cash?
Yeah.
But it doesn't look like it's been making that much profit to be able to invest in all that. And so what you see, if you look at its total number of shares, is that number has just ballooned. So June 2015, the end of F15, 485 million shares. By the end of F19, 1.06 billion shares.
Wow.
So it's more than doubled its share count in 5 years. And there's a saying that, you hear if you listen to Shark Tank or whatever, that equity is more expensive than debt.
Yeah.
And that's very true here, because every shareholder, if they didn't participate in the capital raises and didn't buy more shares every time the company went to the market to ask for more money, it meant they got diluted. And it meant they, if they were earning 1/485 millionth of a share of the company and they were entitled to that much of its profits and all that, they're now entitled to 1.06 billionth of the...
They've more than doubled the amount of shares on offer.
Yeah, which is more than halved people's ownership stakes. Yeah.
So just to be clear, and what you're saying is that instead of taking out debt, which they would generally have to pay back at an interest rate over a period of time, what they've decided to do rather than that is go to the market and offer more shares on issue for people to buy, and they'll take on some capital that way. But the reason you're saying it's more expensive is because rather than having to pay debt back, you're actually diluting the cost and also the revenue that is going to be distributed across to everyone at the end of the day.
100%. So, it's a decision they made. It's probably not a decision that most companies would make. You would at least have some debt before you went to the market and diluted your shareholders.
Yeah, it's an interesting point. Good pickup.
Yes. Yeah. So you got to keep an eye out for things like that.
Yeah, nice.
Yeah. But I think, it's an interesting company. It's probably not one that I would be interested in at this price.
Well, I'm going to be keeping an eye out. They obviously believe that they're underweight in the East Coast market. I'm reading here that they want to target the East Coast with an additional 6 million litres coming across here over the next 5 years. So I'm going to be keeping an eye out to see what their penetration is on the shelf and across the retailers over here.
Yeah, and they're going to open more of these microbreweries across the East Coast as well to, I think, try and build their name recognition.
Yeah.
So if you look in the States, like microbreweries have taken off and craft beers have taken off, and there's definitely a virtuous cycle between brands that have good popular microbreweries that people want to go to and, they get to see, touch and feel how the beers are made, and, it's a real experiential marketing, I guess. And then that reinforces sales at the bottle-o. And so if they can replicate that here, then, it's the world's their oyster, I guess. But yeah, there's a lot of competition in the brewing space. To your point earlier, there's declining beer consumption in general. So a few headwinds that they're really going to have to...
Tough market.
Yeah.
If I was to invest in an alcohol beverage company, I would be looking at spirits rather than beer, to be honest. Yeah.
Gin has had an unbelievable run.
I know. Yeah. Gin has. Looking for the next thing. I think it's going to be mezcal.
What you could do is you could just hedge your bets and say, whatever it is, Constellation Brands or Asahi or someone is probably going to have a big role in it, and just bet on the big end of town. Yeah.
True. I remember telling you about the West Winds gin over in Australia. Kicking myself. Not sure how it's going, but I do see it in the shops at the moment.
Do you?
So, yeah,
Do you?
unfortunately. But anyway, so where do you think this falls in your circle of competence, Ren?
Oh, I think consumer discretionary, consumer staples, like all that is right in most people's circles of competence. Yeah.
Not difficult to understand and not difficult to test either.
No.
Yeah.
You see it, you touch it, you feel it, you buy it or you don't buy it. And a lot of these products, like that's the best determinant. If your mates are rocking up to parties with Atomic beer or Matso's beer, like one of these brands, and they're enjoying them and they're buying them more, that's a pretty good indication that we're onto something. Otherwise, if no one's buying them and you don't see them on the shelves when you go to the bottle-o, or they're, wildly overpriced or whatever it is, that's first-hand market research.
Well, to give you an example, a White Claw is a spritz that's gone nuts over in the States at the moment. Crazy.
Yeah.
So much so that you and I wanted to try and bring them to Australia.
Yes. There may have been an email that you sent.
We emailed them, and unfortunately, international distribution is not currently part of their business strategy, but that's fine. So it led us to look domestically at what other competitors, I guess, or similar products there are in Australia. And I saw that Sofi, SOFI, was doing a through Equitize.
Sofi or SoFi?
So who knows? Or is it Sophie?
Oh.
They were doing a raise through Equitize, so a private raise off market. Anyone can do that though. It's a crowdsourcing platform. And I figured the first thing that I should do before actually investing is go and taste them. They've got 2 flavors. Didn't pay them.
Yeah, they
Didn't
were.
like them.
Yeah.
Average.
Yeah.
And I don't know if that's because I don't
Americans have terrible taste buds.
Well, yeah, white wine and spritz.
I'm joking to all of our American listeners out there.
No, he's not. And so, yeah, didn't pay it. But now I see there's more coming to the market in Australia, so some more testing to do. But yeah, good example of how easy it is to actually go out there and test these things.
Maybe we should brew our own.
Oh, well, yeah, I guess it's not hard to pour goon and a bit of water into a thing and shake it up with some flavouring.
That's your nightcap every night.
Get out of it. Anyway, Reg, we'll leave it there and we'll continue our shallow dive next week.
Sounds good.
Thanks for listening to Equity Mates Investing Podcast, a production of Equity Mates Media. Please remember that everything you hear in Equity Mates Investing Podcast is general advice only. The content has been prepared without knowing your personal objectives, specific financial circumstances, or goals. The host of Equity Mates Investing Podcast may maintain positions in the companies discussed. Before considering any investment, please read the product disclosure statement and consider speaking to a licensed financial professional.